Imagine the market is hitting new all-time highs. Everyone is making money. The headlines are bullish. And suddenly, one question starts appearing everywhere. Is a crash coming? The truth is, nobody can reliably predict the exact day a market crash will happen. But history shows that financial crises often leave clues beforehand. Not a single magic signal, but a combination of stretched valuations, excessive leverage, weakening fundamentals, and rising financial stress. So here are 5 things worth watching. Sign 1: stock prices get too far ahead of fundamentals. When investors become willing to pay extremely high prices for future growth, the market becomes more vulnerable to disappointment. The Federal Reserve's May 2026 Financial Stability Report specifically identifies valuation pressures as a vulnerability, noting that high asset prices relative to fundamentals or historical norms can increase the possibility of unusually large price declines. We saw a dramatic example during the dot-com bubble. Technology really was transforming the economy, but investors pushed many technology stocks to valuations that became impossible to justify with their actual earnings. When expectations changed, the market collapsed. And that's the important lesson. A great company doesn't automatically make a great investment. If you pay too much for a great business, even excellent growth may not be enough to protect you from a falling valuation. But expensive stocks aren't the only thing to watch, because the second warning sign can make a market decline far more dangerous. Sign 2: debt and leverage start building. Debt can make rising markets look incredibly strong, but it can also amplify losses when conditions reverse. Research covering financial history from 1870 to 2008 found that rapid credit growth was a powerful predictor of financial crises. Why? Because when investors, companies, or households borrow heavily, they become more sensitive to falling asset prices and higher financing costs. A 10% decline isn't the same for an investor who owns an asset outright, as it is for someone who bought it using borrowed money. That's why leverage matters. And when high valuations and high leverage appear together, a relatively small shock can potentially create a much bigger reaction. But there's a third warning sign that's harder to measure, and it's psychological. When investors stop asking what could go wrong and start believing nothing can go wrong, the market may be entering a much more fragile phase. Sign 3: speculation takes over. One of the biggest mistakes investors make is assuming that a rising market automatically means a dangerous market. It doesn't. A recent NBR study covering U.S. stock market data from 1792 through 2024 found that booms do not reliably predict crashes. They do, however, tend to be followed by higher volatility, meaning both unusually large gains and losses become more likely. So what should you actually watch? Investor behavior. When people start buying simply because prices keep going up, the reason for owning an asset can change. During the late 1920s, for example, researchers found evidence that some securities were trading substantially above their underlying asset values. And in the 2000s housing boom, research found that new investors were drawn into the market partly by observing other people investing. And these inexperienced investors subsequently performed worse. That's the danger of FOMO. People stop asking, what is this asset worth? And start asking, how much higher can it go? But there's another signal that can become even more important. Sign 4: financial stress starts appearing. A crash doesn't necessarily begin with a giant red candle on a stock chart. Sometimes the first cracks appear elsewhere: credit markets, banks, liquidity, borrowing costs, or suddenly rising volatility. The Federal Reserve regularly monitors these areas because problems in one part of the financial system can spread to others. And history shows why this matters. In 2008, stress in the housing and mortgage markets eventually became a much broader financial crisis. So when investors are evaluating market risk, they shouldn't look only at the S&P 500. They should also ask, are credit conditions tightening? Are highly leveraged borrowers coming under pressure? Are financial institutions becoming more vulnerable? And perhaps most importantly, is something breaking underneath the surface while stock prices still look calm? But there's one final sign that can make all of these warnings much more meaningful. It involves something markets ultimately depend on: the real economy. And that's where warning sign number 5 comes in. Sign 5: the economy starts weakening. This is where the story gets complicated, because the stock market can fall before the economy officially enters a recession. In fact, Researchers have found that financial variables such as stock prices, interest rates, and the yield curve can provide information about future economic activity, although no indicator works perfectly every time. So, what should investors watch? Jobs, consumer spending, business investment, industrial activity, and especially whether weakness is spreading across several parts of the economy. That's important because one weak economic number doesn't automatically mean a recession. The NBR, which officially dates U.S. recessions, looks at a broad range of indicators including employment, real personal income, consumer spending, industrial production, and real sales. And here's why this matters for stocks. Imagine corporate profits are rising today because the economy is strong, but then consumers start spending less. Companies reduce investment, hiring slows, unemployment begins rising. If those trends continue, investors may start lowering their expectations for future corporate earnings, and when expectations for earnings fall, stock valuations can fall with them. But there's an important twist. As of the latest data, the U.S. economy doesn't simply fit into a neat crash is coming story. The Federal Reserve's May 2026 Financial Stability Report identified vulnerabilities including elevated equity valuations, business and household borrowing, financial sector leverage, and funding risks. At the same time, it noted that total business and household debt relative to GDP had continued to decline. That's exactly why these 5 signs should not be treated as a countdown clock. They are things to monitor. Because market crashes aren't usually caused by one number. They're often about the interaction between valuations, leverage, investor psychology, financial stress, and the economy. And if several of these start deteriorating at the same time, that's when investors should become much more careful. The goal isn't to predict the exact day the market crashes. The goal is to understand how risk builds before the crash becomes obvious. Because by the time everyone agrees that there's a crisis, the market has usually already moved.